It is very tricky to actually have what we'd call a price target because you're picking both a level for the markets and then a time frame. And so you're trying to get two things correct. And it's especially difficult knowing that there's really never equilibrium, but we're still trying to figure out where the market level would end up being. Most people who follow and forecast markets tend to do what you just described, which is they give you 3 or 4 scenarios, and they'll say, well, there's a 20% chance this happens, and a 40% chance this happens, and a 20% chance this happens, and so my average target is this.
Right.
I think the flaw in that is that you're now trying to assign precision and probability to 3 different events. That process would make you bullish in the midst of a sell-off, and it would make you bearish at the top.
Today, as crypto investors continue to speculate as to whether we'll see a price drop in Bitcoin and Ethereum in the coming weeks, this crypto cycle is heating up, and Tom Lee remains bullish, with a parabolic rise in the last few months of 2025. Forced selling, leveraged bets, and the usual tug-of-war we see when an asset approaches such a huge barrier. The bigger picture looks very different, though. Analysts are drawing a striking parallel. Ethereum today may be in the same position Bitcoin was back in 2017, when it rocketed from $1,000 into the financial spotlight as Wall Street started paying serious attention. And just like Bitcoin back then, Ethereum is now catching the eyes of institutions, hedge funds, asset managers, and major investors who see its role extending far beyond speculation. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. Bitcoin's price sits just over 120,400, still up over 7% just this week. The community is buzzing, and adoption is spreading across industries from decentralized finance to stablecoins. Even the regulatory environment, often seen as a stumbling block, may be tilting in Ethereum's favor. That makes Ethereum more than just a digital currency. It positions the network as a backbone of future financial infrastructure. And as Tom Lee points out, this is likely just the beginning. With Wall Street's deeper involvement and retail energy still strong, Ethereum's growth story has room to run. The question now isn't if Ethereum will climb higher, but how fast it can write the next chapter in crypto history. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
One of the first things that we keep in the back of our minds is that the equity market is the junior piece of the capital structure, which means that stocks respond to economic data and to bonds and to risk, and therefore all of that ends up affecting how the stock market does. So we don't look at the stock market as the tail wagging the dog, it is the tail of the capital structure. And a second principle we always keep in the back of our minds is that consensus tends to be risk averse and crowded. So meaning what is a widely held view and might even be the most logical is probably also the most logical for most people, and therefore it's not actionable. So we try to think about where the variance or the surprise would occur relative to consensus. And often it makes you come to a counterintuitive conclusion. The third thing that we always keep in the back of our minds is that there are longer-term drivers of markets, and I think the most underappreciated is demographics. That demographics are more important than even economic policy. And it's something I learned when I was a wireless analyst. You know, before I became a strategist in 2007, I'd spent the prior 14 years of my career as a technology analyst covering the wireless industry. And one of the things I learned was that the potential of the wireless industry was underestimated by most people because they didn't think about the demographic impact. That if 18-year-olds had a adoption rate of 100%, like you could see it in Korea in the early days, that meant that as they became 40 and 50-year-olds, the penetration rate of older adults would get to 100%. That means wireless would grow vastly over time because of this demographic impact. We found that the stock market really follows very closely the demographic cycles of people aged 30 to 50. And that's kept us bullish since 2009, because that's when that demographic actually bottomed. And the fourth principle we have is that you can't fight the Fed. In 90% of the instances, when the Fed is dovish, you have to be bullish. And when the Fed is hawkish, you have to be bearish. But 2022 and 2023 was really the exception, because in late 2022, the Fed had to be hawkish optically, but actually they had turned dovish. That's the reason we had turned bullish and stayed bullish in 2023, because even though the Fed was explicitly hawkish, they were actually dovish. But I would say those four principles govern almost 80% of how we view markets. So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, what could the earnings power be, where could the surprise come from, how much will liquidity matter, and how much would risk appetite matter. And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%. Not only was the stock market strong in December, we always established the target in early December. Not only did last year the market rise a lot in December, but it was strong in the first half. But it's directionally correct, because at the time, 5,200 was the most bullish view. I think a lot of life lessons that I live are actually life lessons for markets. I went to a business school undergraduate. I went to Wharton as an undergraduate and graduated, and my first job, which was a stock research firm. And I was very fortunate to have been assigned. When you get a job in research, you don't pick the sector, but I was assigned to the wireless industry, which in the early 90s, it was in its infancy. There were only 34 million cell phones in the early 90s, and today there's 7 billion. So you can imagine that is a hyper-growth industry that has grown faster than even the internet.
Ethereum isn't just holding its ground, it's starting to pull ahead. As 2025 winds down, Ethereum has actually outperformed most other major crypto assets, driven by record on-chain activity, surging developer adoption, and growing institutional demand. While Bitcoin continues to anchor the market, Ethereum's momentum is signaling that it could be a real leader in this next phase, setting the stage for what analysts call its strongest run yet. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
Pivotal to how I view markets. I mean, foremost, the wireless industry didn't generate money. The industry was always borrowing money. And so we had to develop a way to actually value the stocks, the equities, without earnings. For most of my first, let's say, decade of that career, most people I met would say, Tom, the wireless industry is worth zero because they don't make money. But we'd always be like, well, what is the value of their subscribers or the spectrum they own, because they aren't capitalized on the balance sheet. And eventually they make money, but they have to spend marketing dollars to acquire the customers and build the networks. So it was really during that period that I learned a couple of things. One was that you can follow what the bond market is doing to know if there'll be moves in the stocks. So I learned to call our high yield desk every day and ask them the levels of different companies and were they trading better. And of course, if a bond started to trade well, then that meant that the bond market sensed something was improving, and therefore the stock would react. And so that was very helpful. And it really taught me to look at stocks as the junior piece of the capital structure. Whatever bonds
Right.
are doing, stocks will follow.
Right.
Another thing I learned was how important the intangible value of an equity is, because in the wireless industry, they had to front load the cost of building the network and then acquiring a customer. So they didn't make money until 1 or 2 years later. And the wireless industry operated as what you'd call a long-term greedy business. They weren't trying to make money in the short term, but all the investment they were making created value in the future. I mean, that's
Right.
today pretty widely accepted as the lifetime revenue of a customer, or we call it long-term greedy. And that's, a life lesson that you really shouldn't try to maximize how much money you make now. It's more important how much money you make over the cycle. And that's
Right.
how we look at the equity markets. I think the third thing that really puzzled people was that when I was a wireless analyst, and I became pretty well known as a wireless analyst. In fact, I became institutional investor ranked only 2 years after starting coverage of the stocks, which made me, I know at Smith Barney, I was one of the youngest managing directors. I was 28 when I became a managing director there. And I was very, very fortunate to pick stocks almost at the bottom. And people always asked me, and so I had some very famous bottom calls. People asked me, how am I picking bottoms in stocks? And what I have shared with my friends but never shared with my clients was that the stocks I would upgrade was based on me talking to all of my clients. And at the time I might have 70 or 80 clients, so it wasn't hard to talk to everybody. And the ones that they were the most bearish on were the ones that I would upgrade. And the ones they were the most bullish on were the ones that I didn't think would work. And it's an example of how consensus gets crowded. So I use those same principles today when looking at markets. When inflation expectations hit 4.3% 1 year forward, it has always marked a tactical low for the stock market because people get overly worried about inflation. So there's a lot of signal that still comes out of realizing what becomes crowded.
Where does all of this leave us? Ethereum has crossed $4,000, weathered short-term volatility, and is now attracting the kind of institutional attention that once catapulted Bitcoin into the mainstream. Analysts are increasingly framing this as Ethereum's 2017 Bitcoin moment, where the groundwork laid over the past decade finally meets global recognition and capital inflows. But here's what makes this cycle different. Ethereum isn't just competing as a digital currency, it's the infrastructure powering decentralized finance, stablecoins, and entire ecosystems of applications that regulators and institutions are beginning to take seriously. That combination of utility and adoption is exactly why many see $5,000 and beyond as not just a price target, but an inevitable milestone. Over the past year, Ethereum has quietly outperformed most other major crypto assets. Tom Lee and other top analysts emphasize this point. Ethereum's real growth story is still ahead of us. With Wall Street leaning in, developers innovating faster than ever, and adoption spreading across industries, Ethereum is positioned to be a defining force as we head into 2026. The bottom line: the short-term swings may grab headlines, but the long-term trajectory is unmistakable. Ethereum is evolving from a promising blockchain into a cornerstone of digital finance and technology, and if history is any guide, the breakout we're seeing now could be just the opening chapter of Ethereum's biggest run yet.